All right, everyone, time to get started. Thanks for coming. I'm really excited to do this presentation, and it just so happened that we have some news from the Bank of Canada, which I'm sure a lot of you are interested in hearing as well. So let's get started. I do want to talk primarily about all of the changes that we've been seeing, changes ahead, also some changes that have already happened. It has been quite a scene, especially for real estate investors, I've noticed. One of the things that we've, of course, have come up to is the BC flipping tax, and that's a tax that is taxing on the income or the gains up to 20% of that gain. And that's not to forget about the federal flipping tax, which came out not too long ago, and that actually is taxing individuals that are trying to flip homes for a profit, and effectively, even if it is your primary residence, trying to use a business income from that. In addition to that, we recently saw capital gains increases, very quick changes that are coming due as of June 25th. So not a lot of time to adjust and make any changes to that. And we've seen, especially in other provinces, so BC and Ontario have fairly strict rent controls, but some other provinces have also adapted stricter rent controls and enhanced tenant protections as well. So it's getting even more difficult to deal with difficult tenants. I know many of you have probably dealt with difficult tenants before, and it just seems like it's always so tenant favored in many situations and many circumstances. And so, it's more difficult, of course, as an investor, even hard to just get people out of your own home in many cases. And so that's one of the things that is very, very difficult and challenging. Vacant homes and underutilized or underused housing taxes. We've all been having to make filings and claims on our properties to ensure that they're not vacant and not underused. Of course, the short-term rental ban, which is still an ongoing concern, effective May 1st in British Columbia this year. Elimination of the short-term rental tax deductions, and so they made some adjustments and changes to the type of deductions that you can claim if your property is a short-term rental. And there's some zoning policy that is requiring more affordable housing to be built in areas that are unaffordable. And so this is a bit of a misnomer, but for instance, in some major urban centers, the government is wanting to ensure that there's affordable housing being put into unaffordable areas, which means that it just doesn't make financial sense to build multifamily properties for rental use in those markets. So this is just 9 of them. There's other little things, of course, that have also come up. There's some legislation coming down the pipeline restricting large corporations from owning single-family properties, et cetera. But these are probably the 9 major ones that we've been seeing. And I do want to highlight and kind of double-click on a couple of these to go into some more depth and details. The flipping tax is one of the big ones. And so there's the federal one, and that was effective January 1st of 2023. And it basically said that if you own a property less than 365 days, even if it was a primary residence, then they want to charge and claim a business income on the gains. So business income is taxed at generally at a lower tax rate than personal income is. But the interesting thing is they're not allowing you to claim it if it's a loss. And so they want to tax you on the upside, but not if you actually had a loss on the property, and allow you to claim a loss on the downside. Probably the biggest thing that is of concern here is that this does affect pre-sales. And so if anybody is purchasing pre-sales with the intention of selling and being able to flip them without paying a tax, this federal tax is intending on catching that. And BC, not to be outdone, also released their own flipping tax that came out or it's effective January 1st, 2025 for any properties that are sold after January 1st, 2025. And this is if you've owned the property for less than 730 days, so that's up to 2 years. And if up to 20% tax would apply on any of the gains. And these are separate from the federal rules. And so you may be subject to dual taxation on these. This does affect pre-sales, and it affects anybody selling after January 1st, 2025. There is a principal residence deduction of up to $20,000 off of the tax amount. And so if it was a primary residence, you can deduct some of this tax. But long story short, the government is not interested in allowing people to flip homes and be able to effectively pay no tax on those gains. The government is coming after that in a pretty big way. And again, one of the primary concerns and issues we have is on the pre-sale side of things. And I will get into pre-sales and concerns about pre-sales and what to look out for in a little bit. The other thing I wanted to double click on is capital gains. And so this is something that's come up fairly recently. And so it does apply to both personal and corporate. On the personal side and on the corporate side, the new date is June 25th. So any sale of assets on or after June 25th of 2024, the tax is now calculated on 66.67% of the gain instead of 50% of the gain. So it's 2/3 instead of half. Now, one interesting thing, and this is something that that some of our clients are looking into right now, is that for individuals, each individual has a gain of $250,000, where it's up to only 50% of the gain up to 250, and then over the 250 amount per person, the gain is calculated at 66.67. So there may be circumstances here where you may be able to look at restructuring properties. So if there's a property that's owned by two people, you could perhaps add two more people to it, and you'd be able to have more of the gain be taxed at 50% instead of 66.67%. So, by the way, we're not tax accountants or lawyers or anything like that, but this is something to talk to an accountant and talk to a lawyer about if you think that you do have property that you might be exceeding the $250,000 of capital gains on. There might be some options for you to try to save the amount, but keep in mind this rule is coming into effect very soon. Now on the corporate side, there seems to be less options for this, unless somebody has figured this one out. As of now, it doesn't seem like there's any obvious options other than just making sure that you're trying to claim as many of the deductions possible. And there are different ways that you can talk to your accountant about ensuring that your tax base is higher. So if you're doing any renovations to the property, etc., there's different ways that you can write off that as either reduction of income, but also increasing the capital base of a property. So talk to your accountant and make sure that you understand all of those little nuances and rules. I'm actually going to have next Thursday, we'll be sending you an email tomorrow. Next Thursday, we're going to have an in-person event in Vancouver. I'm going to be bringing out a financial planner that I know really well. I'm going to be talking a little bit more about the capital gains. I'm going to be picking his brain a little bit more about some of the options and things that he's been exploring in the capital gains world to see what options he has. But long story short, it's making things a lot more difficult for investors. That's the reality of the situation. With all of these new taxes and rules, it's affecting investing in real estate. And so one of the things we look at is the returns in investing in real estate. And in general, in the past, my presentation used to say that cash flow, you could usually expect anywhere from 0% to 4% return on cash flow. Nowadays, it's more difficult. So if you're specifically trying to find something that's good for cash flow and you're putting 20% down, then properties in Edmonton, in smaller markets, you may find that you may be able to find a small return on investment. So maybe a 0 to 2% return on investment from cash flow. But I would say that a lot of properties in just a typical condo in Greater Vancouver or Greater Toronto, etc., a lot of them are actually negative, and in many ways, fairly negative. In many cases, we see that these properties are negative 5%. I've even seen more than that. So in many cases, we have to actually, when we're calculating the total gains, we have to factor that in and factor in a negative cash flow component. Now, the appreciation, this is based off of what you use for annual appreciation, by the way. So if you put 20% down, that means for every 1% of real estate appreciation, your return on investment is 5%. So I like to use a 3% annual appreciation. That's a reasonable expectation moving forward. And using that, you would expect then that your return on investment from the appreciation factor would be about 15% per year. And then this is the mortgage paydown, which currently is anywhere from 5 to 6.5% return on investment. So if you bought a property, the tenant cover your mortgage payments for you, and if there's no appreciation, the tenant paying down the mortgage for you represent about 5 to 6.5% return on your investment. Now, the good news is you add up all of this, and it is lower. I've seen a lot of analysis sent to me by clients, and a lot of them are anywhere between 13 to 18%. And if they're buying something that has really good cash flow, in particular, I would say areas like Edmonton tend to have much better cash flow. There's other smaller markets that have better cash flow, and that's actually something else we're talking about in our in-person event next Thursday. Is specifically bringing up some examples of some properties that may be a good fit to purchase and would be able to generate a decent cash flow. But in general, the returns on investment are lower than they used to be. There's no doubt about that. So the tricky part is, well, what do you invest in? And if you expect, let's say even on the low end, if investing in real estate might be representing a 15% return on investment, the reality is, the cold hard reality is that that's still a good investment return. If you're going to invest in stocks long term, you'd expect probably about a 7 or 8% return. If you're investing in a lot of different investment vehicles, a 15% return is still very, very solid and very good. And so I think that the challenge is that because the cash flow is negative, it's very difficult and very challenging to really wrap your head around, well, why would I buy a property if it's cash flow negative? So one of the opportunities is to simply just put more down payment down. And it's not a great opportunity, let's put it that way. And frankly, it actually will likely reduce your overall return on investment instead of making 15%. If you put a large down payment down, you make less on the appreciation, and maybe the property will cash flow slightly positive, but you'll probably make less overall. And so it's not a great solution, but for those that are still wanting to invest in real estate, get a decent return, but are worried about the negative cash flow, then the reality is you could just simply put more down payment down in order to make it cash flow. And in general, in Vancouver, for instance, you're probably needing to put, residential real estate 35 to 50% down in order to cash flow certain types of properties positively. It just kind of depends on what type of property it is and where it is. Now, the interesting thing about this is, yes, properties are cash flowing negative right now, but we also want to look at what's happening in the real estate market and where do we project things are going to head with regards to valuations. And one of the concerning things that we're finding, and a lot of people are quite alarmed by this, is looking at the housing starts, so the immigration versus the housing starts, all the way back to 2000 up to 2022. So this chart is actually showing you the difference or the spread between the number of properties that are being, or the number of people that are moving to Canada versus the amount of properties that are being built. The smaller the number, the more that we're meeting the requirements and meeting immigration. The bigger the number, the more people that are moving here compared to the number of houses that are being built. And so if you look at this chart here, we have a massive problem, and the problem isn't likely to pop up until a little bit later. Usually this is a lagging effect where people will often move here, they'll settle, they'll figure things out for a little while, and eventually they want to buy their own place, or they want to move into something a little less temporary and a little bit more permanent. I see this all the time where, a number of Ukrainians, for instance, have moved to Canada, and a lot of them are just renting and living in with somebody else, a Ukrainian that's moved to Canada 10 years ago, and just living and sleeping on their couch or renting a room or whatever. But eventually they are going to find their own housing and want to live in their own space. And that's where a couple of years down the line is likely we're going to see more of a problem here, where way too many people are moving here compared to how many properties are being built. We haven't seen, especially 2 years in a row, we haven't seen this for a really long time. And guess when the last trend was getting bad, 2018 and 2019, and guess what we had? We had a massive run up in housing, and COVID didn't help that. But also, of course, it probably wouldn't have been as bad if we were building more homes earlier on. So these are definitely some concerning numbers when you look at the percentage of housing starts compared to the number of new immigrants. And in 2021 and 2022, that number is only 57%, and for almost 20 years, that number was on average about 77%. And so one of the charts then we follow and look at is the number of housing starts, and the primary concern here is, yes, we can see that that number had increased, but the trend is going down, and there's a number of reasons for that. But when I talk to a lot of small to medium-sized developers, part of the problem is it takes way too long to get anything approved in many major urban centers. Like in Vancouver, it's often 2 years to get permitting. And the other issue is that if the interest rates are very high right now, it makes it much more expensive for you to carry that debt. So a lot of the banks and credit unions that would typically have financed and funded a developer or builder in the past, a lot of them have turned away and said, no more land financing. We're not interested in financing you in land anymore. which means that in order to be able to acquire the land, they have to do it with cash or they have to get private lending. And private lending, all of a sudden, because they're usually prime plus 4% or so, has been around 11%, sometimes even 12% interest. Now, if you have to pay 11 or 12% interest just to hold the land for 2 years before you can start to build and then hopefully make a profit, that's a major issue and a concern for builders. So they're just finding that the demand for brand new and for pre-sales is definitely decreasing, and so a lot of builders are saying, you know what, the profit margin is not there. I'm getting squeezed. My costs are rising because the interest cost is rising, my supplies, my labor costs, etc. And on top of that, I can't really sell the properties. I have less people that are interested in buying a pre-sale. Now, going back to a few slides ago, keep in mind that there's new taxation regarding pre-sales, and so we have less investors who are willing to say, yes, I'll buy your property, and with the intention of selling it in the future. And so if the developers are not seeing those pre-sales come in, they can't get their bank financing to build out the property, and it's less likely that they can guarantee that they'll be profitable if they were to build it. So there's a lot of issues right now and concerns, and I don't know if this trend is going to change at some point in the near future. But as of right now, a lot of builders are saying, you know what, this just isn't a great market to be selling into. They're tapping the brakes and deciding not to build anything. And so this trend going down is going the opposite direction it needs to in order to be able to provide housing for all the new immigrants. So getting the crystal ball out and looking at things, my crystal ball hasn't been working a lot lately, especially if you ask me about rates. But if you look at it, this is fairly typical of what major banks have been predicting. And so they looked at changes in prices as far as what has already happened in 2023, and then the forecast. And most of them are not going crazy and going out on a limb here. But they do and are projecting that in Q2, Q3, and Q4 that home prices and home sales will be higher. And so if you look at the chart here, the forecast was that the sales would tick up and increase and be much better than what we saw pretty much all of last year, except for that very, very succinct but very hot spring market that we saw where prices and home sales had skyrocketed. The projections here are a little bit more tame. But if you look at the chart here, the darker green in Q3 and Q4 of this year is showing a bit of an uptick in home values. Some of the charts that I've seen from CMHC and other banks going into 2025 actually is showing, even high single-digit increases in home values in 2025. I think CMHC's report actually was saying something between 7 and 8% increase to residential real estate by the end of 2025, which is a fairly significant increase. And so the general consensus is that prices are not likely to go down; they're actually likely to go up. And of course, news like what we saw this morning with the Bank of Canada decreasing a 0.25% is only going to add a little bit of fuel to that fire. So the challenge is if you're looking at buying residential real estate, you're looking at, okay, well, I've got negative cash flow today, but I also expect that values will be higher in the future. And so the question is, like, how do you deal with that? How do you manage that thought process? And one of the things to look at is, well, if I'm borrowing a 500 grand, let's say, then 1% interest cost, let's say that the interest rates do decrease by 1% over the next 12 months, would mean that if you were to wait and borrow money in the future, that maybe you'd save 5 grand in the interest cost over a 12-month period on one mortgage. On the flip side, however, if there's 3% annual appreciation on a property worth 500 grand, then your appreciation return would be $15,000. And so the question really comes down to, if you expect that values will go up in the future by, let's say, 3%, even if the mortgage rates decrease by 1% and you could have obtained a better mortgage, you could have obtained better cash flow on that property, the home appreciation may outstrip it, especially if we do get into to appreciation rates that are in the high single digits. So again, it's really hard to predict that. And in many cases, especially for those that are in situations where you can't afford negative cash flow, you shouldn't be banking or expecting that interest rates are definitely going to go down. But there is some precedent and some estimations that are predicting that moving forward. So, of course, talking about interest rates, the question of, will rates go up or go down? And, this question, a lot of people have assumed and suggested, well, obviously rates are going down, but hasn't always looked like that. The charts and the expectations, et cetera, can move all around. But today, for the first time in 4 years, the Bank of Canada did decrease interest rates by 0.25%. What this means for you is that your next payment will likely be still at the current payment, but the following payment, if you're in a variable rate mortgage or an adjustable rate mortgage, I should say, would actually decrease, and it would decrease by approximately $14 per 100 grand borrowed. So a little bit of a relief there. If you're borrowing money in the line of credit, then it's about $21 per 100 grand borrowed. So you'll likely see that your payments will decrease if you're in an adjustable rate mortgage. Now, most major banks in Canada have a fixed payment variable, which means that you wouldn't see your payments actually change. You're just going to see the amount going towards principal and interest will change and adjust. And so just keep in mind that most major banks are a variable rate mortgage where your payments are static. But banks like Scotiabank will have an adjustable rate mortgage, and most non-bank lenders have an adjustable rate mortgage, where as the prime rate moves up or down, your payments will move up or down. Now, after that move, something that I like to look at is the people that bet professionally and what they think is going to happen with the Bank of Canada. So if you look at the meeting dates here, they've got the 4 dates listed out for the rest of the year, and then they have what's called the implied rate. So they dial it right down to fractions of a percent here, but they're making bets on where they expect the rate would be, and those bets are accumulated into a number here to determine what the expectations are. What this means, so basis points is basically a fraction of a percent. So basis points for July being down by 10 basis points means that they think the rate would be 0.1% lower. The way to look at this is that they're betting and banking on about a 40% chance that the Bank of Canada drops 0.25% in July. For September, they've built in 28 basis points, which means that they fully priced in one full cut of from the Bank of Canada by September. So 40% chance they go down in July, but about 100% chance that they go down in September. Then you see October, and there's about, again, another 40% chance they might go down one more time after September. And then by December, they've built in basically 100% chance of a further cut. So what this is telling us is that we've already seen 1/4 point cut, and the market is pricing in by September one more cut, and then by December one more cut. And it doesn't mean that they're going to move at these same speeds. For instance, for the last couple of months, this same chart here has been pricing in about a 50% chance of a cut in June, and by July, 100% cut. And now that we saw some weak inflation data, which is good, by the way. We saw some weak data in the US as well, and that needle moved up to about an 80% chance the Bank of Canada was going to go down in June, and sure enough, they did. And so we're going to see that pendulum swing, by the way. Back in January, when I was looking at December, for a while they're looking at between 4 to 5 total cuts by the end of the year, and now it's basically looking like it'll be in total 3 cuts by the end of the year. But at least it does seem like the rate cuts are around the corner here, and it looks like variable rates are going to start to become perhaps a little bit more of an attractive option when considering whether to go variable or fixed. Now, that being said, keep in mind that the Bank of Canada decreasing rates does not necessarily mean that fixed rates will go down. That being said, the bond market has reacted, and since some of the news that came out Friday, Monday, Tuesday, it's been a lot of positive news for those that are looking at borrowing money, because the bond market has also been decreasing. So just in the last 5 days, the bond market has gone down 0.4%. Now, we're not sure exactly whether banks are going to be passing on a lot of this in savings over. Keep in mind that in general, when rates go down this quickly, they're often going to rebound and come up a little bit. So the banks like to just wait it out a little bit and see what happens. I would expect that if they stay flat and stay this low for another day or two, then by Friday we might be starting to see some lenders come out with rate cuts for fixed rate term products. Now, something else to look at here too is that if you look at the chart and go all the way to the left, back in the end of March, early April, we're back to about those levels. And so we do have some clients that got an approval back, a couple of months ago, and now they're expecting, okay, well, have this rate, and unbeknownst to them, the bond market had gone up and now it's coming back down again. Well, if your mortgage was priced back here with bonds that are about the same as where they are now, then your pricing probably isn't going to be drastically different as of today versus what you got 2 months ago. So really, we're watching this bond chart to figure out where things are heading. And the reality is that we do expect that if this trend continues or at least stays the same, that we should be seeing more competitive fixed rates come out in just a little while, but it will take some time. The Bank of Canada coming out and saying rates are going down does not mean that all fixed rates are absolutely going to go down. In fact, because the market had been starting to price in these cuts, it was not just the Bank of Canada going down that caused this. It's also that in the U.S., their bond market is showing decreases on the yields, and that's because there's some weakening coming out of the U.S. too. If the Bank of Canada dropped 0.25% and no other information or data came out that also showed weakening U.S. or Canadian economies, we may not have seen much of a decrease in the bond market, and so we may not have seen any potential decreases for fixed rates. But based on this is good news, especially if you're looking at borrowing money in the next little bit. It is showing that there might be a little bit of downward pressure on fixed rates coming very soon. So, looking at the trend here, fixed rates, probably relatively flat to decreasing long term. We're going to see some ups and downs, and obviously, immediately we may see a slight decrease, but I think still projecting for the next couple of months, we're not expecting major decreases to interest rates on the fixed rate side of things because the bond market has already priced in most of these cuts. But now all of a sudden those cuts are starting to be priced in a little bit earlier and just a little bit more than what they were pricing in as of a couple of months ago. And on the prime rate side of things, my last presentation I did a couple of months ago was looking at maybe 0.5 to 0.75% lower by the end of the year. Basically, they're looking at in total over 2024 being down by 0.75%. So if you include today's cut, then a further 0.5% in cuts by December. And so one of the things that we're going to be comparing a lot is, well, should a 3-year fix, which is probably the most commonly chosen term. Some lenders are as low as 5.29% for 3-year fixed, and then a variable rate, which is now getting a little bit more competitive. And there are some major banks that are offering prime minus 0.9, which is 6.05. And if you're an insured mortgage, then there's lenders that are even offering better than prime minus 1. So rates are starting to get into the 5s for variables, the high 5s, but still getting into the 5s if you're taking a variable rate. But that's typically for an insured mortgage. So based on that, if interest rates are going to drop and fall, is now a good time to buy. And the interesting thing is there were some reports, and I have to question them a little bit because they were reports done by realtor companies, by the way. But some reports, I was reading one by Royal LePage that said that up to 50% of people that were interested in buying were waiting until the Bank of Canada drops 1 or 2 times before entering the marketplace. And I do think there's a little bit of truth to that. There are some first-time home buyers in particular that are sitting on the sidelines and waiting for rates to drop a little bit before they jump in. But I also wouldn't expect that 50% of the people sitting on the fence are all going to rush in all at the same time. That being said, this decrease is a small signal, but it's still a signal. And if I look back to last year, in January, the Bank of Canada said, hey, we're pausing our increases to rates. And you know what happened? All of a sudden, we had a big buying frenzy, and a lot of people were jumping in. And that was just the Bank of Canada signaling a pause. So based on this, where they're signaling, okay, now we're decreasing, but cautiously, but starting to decrease and starting to go back downwards, that may have another effect on buyer mentality. And so we may start to see more buyers start to enter the marketplace. On the opportunity side of things, I am seeing that a lot of pre-sales are sitting on the market. And so pre-sales seem to be something that for whatever reason are just a little bit harder for those investors to unload and offload. You might be able to find perhaps an investor who has bought a pre-sale that is looking at trying to get rid of it. And one of the interesting things here is that if you know somebody who is a first-time buyer will be able to actually get a 30-year amortization on a brand new property now. And so if you're a pre-sale purchaser, then just note that if you can find a first-time buyer to buy it, they can get a 30-year amortization putting less than 20% down, which wasn't available for, it's been at least, I think, 10 years since that's been available. So that's something that would help and be a little bit easier to find a potential and suitable buyer for that. And I think just in general, if you're an investor looking at buying a property, I think there are a lot of investors who made commitments to buy these pre-sales. They can't complete. Now the interest rates have gone up. It's harder to qualify. And I think that might be an opportunity to be scouting out and perhaps talking to some realtors to see if they can source some pre-sale properties for you. So one of the other opportunities that I want to bring up here too is the government has been it's been very difficult to deal with the last little while because of all these rule changes and all of these adjustments. And one of the things that I've noticed is at the same time that they've made it harder for ma and pa investors to buy rental properties and own real estate, they've also been incentivizing larger investors and larger entities in building larger multifamily properties. And so I've done presentations in the past about CMHC insured multifamily financing. So if you're doing a 5 or more unit property, there are opportunities there where you can get up to 95% financing, even in extreme cases, up to 100% financing, up to 50-year amortizations. The interest rate is actually lower than a regular residential mortgage rate. It's the only type of product that you get a better rate than residential, because every other commercial type of mortgage was more expensive. And it seems like there's just a lot more incentives to go that direction, and the government's really pushing that angle. And so I'm very interested to see if that trend continues. But I think it's worth considering maybe instead of owning 100% a bunch of units yourself, or owning a couple of single unit rentals yourself 100%. Maybe instead of doing that, it may make more financial sense to instead be a smaller part of a bigger pie, and perhaps invest in a larger building or a larger opportunity. So that's called, investing through in private equity or through an exempt market dealer. There are lots of different opportunities out there, and if you do want to learn more about that, I have done some presentations in the past, but I also can just connect you to somebody that might be able to go through a bit more of that with you. But I just feel like the government is making it harder for ma and pa investors to own real estate, whereas they're incentivizing people to build multifamily properties on a larger scale. So I think that might be an opportunity, and sometimes if you can't beat them, join them. And it's really hard to beat the government. So it might be easier to just say, okay, government, I can see that you're obviously pushing a lot of money in this direction. Maybe that's the direction that I should be taking. Another opportunity too is on the private lending side. So I've had a lot of clients that say, you know what, Kyle, I'm just not really sure if I want to own real estate in this kind of market. And private lending is a really good opportunity for that, because although the Bank of Canada dropped rates a little bit, and that generally means that the private lender, that it means that overall on the private lending world, interest rates usually drop, so your return by being an investor could decrease a little bit. On the flip side, it's important to think about the fact that if you want to earn a return and you like investing in real estate, then being a lender could be a way of doing that. To give you an idea of what a private lender would typically look at is we would lend out money at perhaps 65% of the value of the property. So a borrower has at least 35% equity in the home, and a typical interest rate might be around 8.5% to 9%. Plus a fee. So the APR for a lender is usually somewhere in the 9% to 9.5% range. And if you're doing a second mortgage, especially if you go to higher loan amounts, you may be able to achieve a higher return. So a second mortgage often is anywhere from 11 to 12% interest. And if you really push it, I just did one with an investor recently, up to 80% financing, but we felt very strongly that the borrower had a really good exit strategy and was stronger than your typical borrower trying to max themselves out. That loan was priced at 14%. So just really depends on the situation and the circumstances that you're in. But just something to think about is that if you want to invest in real estate, but you don't know if you want to be owning it for the next little while because you're just not sure what was happening, or you do want to focus more on cash flow instead of capital appreciation, because that really is the tug and pull right now, then perhaps being a lender instead of being an investor would make a lot of sense. There is a question that I'll answer here too. So Ellie, you're asking, mentioned for current homeowners with mortgages, today's rate change will affect those paying variable by about $14 every 100,000. How does this affect a borrower that's looking to purchase? How much more can they afford? So the reality is, it won't affect a purchaser on their affordability a whole lot. And the reason for that is that most of the borrowers, especially if they're right on the edge right now, they're having to go with a fixed rate just in order to be able to qualify. And so it probably won't change qualifications because somebody that's trying to stretch themselves often has to take a 5-year fixed rate just because that's the lowest option that's available. Like shorter term fixed rates are more expensive, and then longer term fixed rates are a little bit cheaper. And so many people that need to squeeze in are having to go with 5-year fixed rate, and they don't have a choice, even if they wanted to go variable. So the problem is that variable rates are high, which means that it's harder to qualify. So a lot of people end up having to go fixed. And as of now, the fixed rates haven't changed. I would suspect that if the fixed rates do drop a little bit, it'll be a little small drop in the pan. So if we see a 0.1 or 0.2% decrease to interest rates, it might be, a 0.2 or 0.4% increase to a borrowing power. It won't be significant, but it won't be immaterial either. So yeah, hope that helps. So I do want to give everyone a very quick update. So for those of you who have been following me, I've been basically turning what looks like a spreadsheet into software, and so we're very close to launching that internally for ourselves to be able to more easily assess borrower capabilities and qualifications. But as of right now, we're still utilizing the software in its current state, which allows us to underwrite and look at 32 different options with lenders. Without having to get a credit bureau or documents. We just get you to fill in information, and we can run it in our system and just pre-screen it before you send in all the documents and go through a full application. So if you just wanted to get a rough idea of what you might qualify for before you jump in head first and do a full application, then our software would allow you to do that. And if you'd like to book a consult with us, then feel free to reach out to us. You can go to our website and learn more there. Also on our website, we just posted a quick blog about the changes to the interest rates that happened today, so you can learn a little bit more about that if you wanted to. And of course, if you wanted to get a copy of my book, Rockstar Real Estate Investing, many of you probably already have that book, but if not, please shoot us a message or an email. We'd be happy to get a copy of that out to you. And of course, if you have any questions, you can reach out to us at this information. So I know that there's not really a conclusion here, and I should probably add one. The reality here, and the question that I get a lot of is today a good time to buy real estate? And the answer is, it's an okay time to buy real estate. And the reason I say it's an okay time is it's hard to isolate today and look at it and say, high interest rates, values haven't really come down enough to offset the high interest rates. We have all of the, this government meddling and all these other things that are occurring right now. The issue that I see is I still think that investing in real estate will generate a higher rate of return, and have more faith in generating a higher rate of return in investing in real estate than I do in investing in stocks or something else. So that's one thing. And the second thing is, I do believe that if you give it 2 or 3 years, that you're going to look at this and think, oh my gosh, I'm so glad that I bought real estate because the property values just went through the roof. I can't believe they went higher than they already were. Because we're seeing a trend here, which is less new properties being built, lots of people moving here. And so you're going to have a supply shortage in a couple of years. And there's some reports that are saying that that's pegged at about the 2-year mark, maybe the 3-year mark. So, into 2026 or 2027. In addition to that, the other consideration or concern with buying in the future is that if interest rates are going to go down, which it looks like they will be, then you have a lot more people trying to enter the marketplace and buy at the same time. And we're going to see that there'll be a bit of a buying frenzy. So more demand, less supply. In general, when you have higher demand and lower supply, you're going to see prices rise. And so I do think that maybe today doesn't look like a great time to be buying. But I think if you start to map it out and start to look at, well, what happens if the values do go up as much as maybe CMHC is predicting? You may be better off to be trying to negotiate with somebody now, trying to buy something in today's climate without having to jump over 10 other people to buy something, and locking yourself into a price, and perhaps not locking yourself into a mortgage. Maybe the way to play this is to go variable and let yourself ride it down and hopefully take advantage of lower rates in the future. So if you're not willing to do that on the residential side, then there are other opportunities of investing in different things. Investing, if you like real estate, investing in the debt side of it, because the rates are quite high and therefore the cash flow return is quite high. Also, if you're looking at investing in real estate and you just want to be maybe taking advantage of the opportunities on the CMHC insured multifamily, but you don't really have enough capital to play in that sandbox yourself because you need quite a bit of money to do that, then maybe investing into some projects where people, builders are building these types of properties that the government is wanting and needing, and taking advantage of the preferential financing terms that those larger entities can obtain. So yeah, it's just a matter of finding the opportunities, and there will be opportunities. There are people that need to sell properties, and I've been seeing some really good opportunities hit my desk where my investor clients are getting some pretty smoking deals. And yeah, the financing cost is in many cases difficult to get around, but I think if you can get a good price, then the rate pill might be easier to swallow. So thank you for coming to the presentation. I will answer some questions. If anybody has any questions for me, I'd be happy to answer them. Any questions for me? You guys are taking it easy on me today. You're probably looking outside like I am and looking at blue sky, which we haven't had for a while. Oh, Linda, so wondering about the 4 people versus 2 with capital gains. Yeah, so that is the idea I think that a lot of people are trying to execute, which is just to add more people to a property so that the capital gains, because each one of the individuals gets to for their own personal gain gets up to the $250,000 limit. So let's say that there is a gain of $1 million on a property, and there's only 2 people right now on the title. In theory, then you could add 2 more people to the title. So now there's 4. Each person gets to add their $250,000 eligibility, where they only pay 50% of the capital gains, so that instead of 2 people having to pay the 66.67% on $250,000 each, then everybody is underneath the bar and only pays the 50%. So again, I'm going to preface this by saying make sure you talk to an accountant and discuss this, but that's the general concept in theory. Just you got 3 weeks to execute it. That's all. Jerry's asking in a pre-sale, does the date start on the date of contract or the date of completion? So it depends on the on a pre-sale, they're looking at the date it was sold, and the date that was sold includes if it was an assignment, and so the date of the assignment is also factored in. So if it's an assignment, then that's the date that now is being triggered for this. But it is the date that is sold, at least for the BC flipping tax, and I believe it's for the federal one as well. I'd have to double check. There's tons of reading to do on those dates, but my understanding is it's the date that it was sold. Awesome. I have a couple of questions in the Q&A as well. Okay, so Ali's asking, is this a good time to sell our property for upgrades? In theory, if property values are decreasing, if they're decreasing, then you're better off to be upgrading in that kind of market, because you're going to, let's say that the market goes down by 10%, and that's not necessarily true, but I've seen it in some little pockets where this is the conversation that's coming up. If property value is going down by 10% and you're selling a $500,000 condo to buy $1 million property, that means you're going to take a hit of 50 grand on your sale, but you're going to gain 100 grand off on the new purchase. And so in theory, if property values are stagnating or dropping, then you're actually better off to be upgrading in that type of market. It still seems difficult to peg this market, because certain properties tend to be sitting for a longer period of time, and certain properties are moving real quick. A lot of the properties that I'm working on, a lot of them are multiple offer situations. So it really depends on the situation. But I have some clients that are in maybe the suburbs where properties tend to be sitting a little bit longer. Mark is asking, you mentioned Edmonton earlier. How do you feel about Toronto and Ottawa single family homes, broadly speaking? Toronto condo or Ottawa single family? I think Toronto right now, I would be a little cautious unless they got a really good deal. I'm hearing a lot of stories. There's a lot of supply of condos in Toronto. And so if there's more supply, and I suspect that values will be decreasing, then I'd want to be undercutting that decrease. And so I'll probably be a little bit more aggressive on my offers. I'm not completely in tune with either the Toronto or Ottawa market, but what I'm hearing anyways, there's a lot of product going up in the market there. Ottawa's a bit of a different one. It's always been a bit more of a steady 80 type of market. That being said, I'm thinking about where the spending is happening, where the inflation is happening. I've seen some charts, and a lot of the charts are saying, hey, you know what, a lot of the spending is happening in the government sector. And guess where a lot of government employees live? Ottawa. And so it feels to me like there's been a lot of push, and I don't know if a new government comes in, like if the Conservatives get in, if that trend might reverse. I doubt they're going to come in and they're going to slash the government employee base by 30% or anything drastic like that, which would have a negative impact, in my opinion, on Ottawa more than other areas. But I don't suspect that would be the case. But I think that they would at least slow things down, so that might affect Ottawa real estate pricing to a certain extent. Ottawa is interesting because it does seem like it cash flows reasonably well. In general, if you can find a house that has a basement suite, it should generally cash flow a little bit better than a Toronto condo, but hard to say, you know, with definitively, I guess. Edwin asks, would signing a pre-sale contract affect mortgage eligibility for a separate purchase, or only once the pre-sale is completed? So only once it completes. But you want to be careful, Edwin, that you aren't in a situation where you've committed to a pre-sale, you buy something else, so now you have more debt, and then you go to close on your pre-sale, and then you realize, oh crap, now I can't close on the pre-sale. So a lot of the time what we do is we actually build a file, and we say, okay, you have a pre-sale that closes in 2 years from now, and you want to buy property today. We build a file, and we say, okay, let's look at whether you qualify for this property purchase now, and then we look at, will you qualify for the pre-sale in a couple of years' time from now? And make sure that you're not shooting yourself in the foot by buying the property today, and now you can't qualify for the pre-sale in the future. Awesome. Any other questions? Okay, good. Well, what I'll do is I'll wrap up the presentation. Thanks everyone for coming out. If you have any further questions, please shoot us a message and reach out. But thanks so much, and happy rates dropping. Woo! Thanks, everyone. Bye.